G'day guys, welcome to another episode of the Pumped on Property Show. Now today I'm talking about honestly one of the things that I am most passionate about as an investor, and that is long-term, short-term, medium-term performance, but most importantly like understanding the craziness behind the crazy, which is investing. And I think in today's episode that's where we're going to get so deep. We want to talk about what's worked in the past and what you can do with that information to hopefully make better decisions moving forward.
Man, when I was first moving up to Queensland and starting to get into investing, it was so overwhelming to try and figure out what bloody Australian property markets perform and why, and really have to figure that out. But, 4 years down the line, 5 years down the line, doing thousands and thousands and thousands of hours worth of research on the market, it's really enabled me to kind of understand how these things work. So I'm really excited to kind of break down the longer term performance, medium term performance, short term performance around all these different areas in Australia to try and help people take that out of their head so they can just focus on what really matters and stop living, up in the clouds where it becomes super hard to figure out where you should be putting your money.
I love that, man. I think the biggest rock in terms of where this podcast should start today is when we got that piece of information, I think you sent it to me from CoreLogic, around the difference in the performance of the metro markets versus the regional. So explain that to people.
Bro, that was so important to see. CoreLogic constantly produces just amazing articles about the Australian property market, but that one, along with the houses versus units, was just one of the most impactful articles that I've ever read. Now, what they did there was they actually analysed the 7 metro markets in Australia, and they compared them to the performance of the 7 largest regional markets around Australia.
So the good markets.
The big ones, Goldie's number 1, I think Newcastle's number 2, Sunny Coast is number 3, big markets. And what they did is they compared it over a 20-year period. And over that period of time, the metro markets outperformed the regional markets by 85%. That's massive. That's not money that I'm willing to leave on the table. And I think by now everybody realizes property is a longer term asset, and I want to get the best ROI, return on investment, over that 20-year period. So, that really helped me just go, all right, while I know there's been a lot of high performing regional markets, I'm not going to, gamble there, and I'm just going to stick to what these guys have told me.
I love that, man. I think what that particular piece of information did for me was shut the door on a whole lot of suburbs that are no longer relevant. So we sort of get to this later, and we will talk to regional markets in a moment and the huge benefits there. But according to CoreLogic, there's 12,000 suburbs in Australia.
Screw trying to go through 12,000 suburbs, eh?
And I'm not sure how many of those suburbs would be in Australia's capital cities, but you'd be talking about, trying to pick a needle in a haystack if you're trying to bet on everything versus going, I'm just a city investor, and that's the decision that you and I both made. I do own regional property on the Sunny Coast, which I love, and there's a method to my madness, which I'll explain later. But for my key investments and the things that aren't to do with a little bit more speculative stuff or a different strategy, I'm all in on the Sydneys, Melbournes, Brisbane's, Perths personally, because not only is that where historically things have done so much better, but it's where the population's growing, the infrastructure's growing, people's incomes are rising, and internationally speaking, people only know Sydney really, and then they hear about Melbourne and sometimes Brisbane, but you want to be not just in the cities that are being speculated on by Australians and where people want to live and the high income earners and the business people want to be, but you want to be where the internationals want to speculate too long term. And you've seen this in your Sydneys, your Tokyos, you can see it in your New Yorks, your Chicagos, your Texases, the centers of America and Europe that are the global cities are the ones that have gone up exponentially more because the whole world is speculating in those assets.
For sure. And I think coupling on top of that, which we haven't written down on this page, it is looking at the comparison versus houses versus units as well, because Another very similar article that CoreLogic did, they looked at the 25 years in Australia comparing houses versus units, and it was close to 100%. It was 96% better off houses were than units. And it's like, if you can just use those two things in your investment strategy, buying in the major metro markets, buying houses on bigger pieces of land, you're putting yourself in a far safer, far better position than majority of investors out there. And, I think that's just takes a lot of the pressure off making that decision.
Massive amounts of the pressure off. So Simon and I very quickly after that research decided to, in terms of understanding, the reason we put this question up, like what Australian property markets perform and why, wasn't as a theoretical. It was so that we had a blueprint for what we wanted to invest in. Now, we asked this question internally 5 years ago, and we've been trying to discover it so that I'm an investor that's not going to go out there and own 10s or 20s of properties. I'm going to have a tiny portfolio of the best assets as an average Australian.
100%.
So if I'm only going to do 2 or 3 or 4 properties in my entire lifetime personally, and I want to be a great dad and I want to be a great friend and I want to run a lifestyle business, not like a 50, 100-hour a week business, then I better make sure that I'm disciplined enough to figure out what the fuck actually works so that those 3 or 4 properties that I do end up owning are the right ones and set me and my family up in the best way. And this is where it come from me. Like, the motivation to answer the question was, I've got little kids at home that I'm at work right now doing my passion and what I love, but I'm still trading my time away from them.
Yeah.
So if I'm going to trade my time for money and then put that money into an asset, I better make sure the return on my time and the return on my asset is the absolute best. So houses, metro markets was number one. And then, because Simon and I like geek out on this shit, and I hope you guys do as well, like, we went, well, it can't just be houses and units.
No.
Obviously, certain cities, certain places within those cities, certain distances from the cities must have an effect. And so we've gone down this rabbit hole and we found so much data from so many different sources that sort of support this concept of timing, and that certain cities do well at certain times of the cycle. Like Sydney and Melbourne seem to do really, really well, like LA and New York do after a GFC. Then they get to a point where they're pretty expensive and some of the money moves out because it's just like, I just can't afford to buy LA for $3 million right now, but I can afford to buy like San Diego for $1 million.
Exactly.
And so it's like, and Brisbane's San Diego.
Yeah.
And so it's like, cool, like I can't buy my dream home for less than 1.5 million in Sydney, but I can get it for 600 grand in Brizzy. And my job, I'm only going to take a 6% haircut on my wage. And my boss now, after COVID, will let me work up there remotely. Like, I'm going to give it a crack. And that's why I've seen like over 30,000 people move to Southeast Queensland last year.
Exactly. And my personality type is always searching for like the most efficient way, the path of least resistance. What can I, lowest amount of output to get the lowest amount of input to get the most output. Like, that's how I like to operate. And it's like, if you can use all of these things to your advantage, and all it takes is like, really diving deep into the data online. Like, even before this podcast, we jumped online. It took us like 10 minutes to get a few different articles up, to have a look at a few different numbers for how these different markets around Australia perform. And it definitely makes it a little bit easier to analyze that. But I just want to make sure that if I am spending this much money, so my motivations are slightly different at my stage of life, which is like, I've worked hard to save up the deposits that I'm using. I don't want to waste that money. I don't want to save for 4 years to invest $100,000, $200,000 to then have that $100,000 or $200,000 do nothing for me for the next few years. Like, I want to make sure that I'm putting it into the right market, that I'm getting the best return on my investment. And it's like, have I, for example, had somebody not have done any research in 2010 to 2012, and they just decided to buy a property in Brisbane as opposed to buying a property down in Sydney, 10 years further down the line to 2020, 2021, where we're at now, the impact of that one decision is dramatically different for the two people that chose either Brisbane or Sydney. So if you can use that timing to your advantage, on top of all of this other stuff, just going to speed that journey up.
I love that, man. So if I look at the 10-year performance of Sydney, for example, it's done an average of 8.3% per annum. Now,
so good.
if you had have looked, that's in 2021. If you had have looked at the 10-year performance in 2020, it would have been 5.5% per annum.
Yeah.
So one incredible year can completely distort data, and that's why I recommend that people learn to interpret data better, because it can be skewed so heavily by outlier years. What I like more than that is the average return. When you look at the total amount of return divided by 50 years in Sydney, between 76 and 2016, it went up by 9.6% per annum, averaged. So that's more appealing to me, to go, shit, 10 years is whatever. It could have been a good 10 years or a bad 10.
When you look at that 10-year performance in Sydney, it's quite close to the longer term performance over the last 50 years. So that's awesome for Sydney, right? It's performed extremely well. But then you look at a market like Brisbane, for example, which over the last 10 years has only done about 3.3% year on year, but the long-term average has been about 9%. I'm kind of seeing a bit more value. I can get a little bit more bang for my buck up here in Brisbane. So, I'm going to prioritize that market up here.
I love that, man. And that's not just a thought that you and I had. Actually, it was a thought. It was a thought that I had way before it was reinforced with true data. But thankfully, Ryan from On Property and Jeremy Shepherd, you can have a look over at Ryan's channel, looked at this. And Jeremy's a data dude to a level that's so much further than I am. And he looked at, I think, was it 20 or 25 years of Sydney performance?
25 years, yeah.
And what he found within the Sydney market is that areas that have performed extremely well in the first 10 years of a 20-year period historically don't perform as well in the second. Areas that have underperformed in the first 10 years generally overperform in the second. And so I sort of took that information and went, well, Australia's just one big market. And, if Sydney and Melbourne have performed extremely well in the first half of this cycle, then what have they done in previous cycles in the second half? And sometimes they've done really well, and other times they've done actually really poorly. But what I could see is that Brisbane has always performed pretty averagely in the first half, and exceptionally well so has Perth in the second half. And I kind of went, well, now we've got metro houses, but then we've gone Sydney, Melbourne, Brisbane, and we've gone, for me and you, Sydney and Melbourne don't make sense anymore. Too expensive, shocking rent returns, massive amounts of over-leveraged people, which represents down the line risk to me. Brisbane is dirt cheap with great yields, and 25% of Australia's population, job and infrastructure growth is coming into southeast Queensland, and now in Olympic Games, and now almost more private capital per capita than any other place in Australia. And Perth is epic, but I don't understand it, and I don't buy booms and busts. I don't like the fact that half the town moves there when it's good, and vacancy rates went from 12% 3 years ago to 1% this year. And then when, the mining thing's over, everyone pisses back over to the East Coast, then,
exactly.
The vacancy rate becomes 15% again.
Yeah, you've got to understand your risk profile and, how you're going to make decisions as well. And, looking at the percentages, it's about 12% of Australia's population and infrastructure growth goes over to Perth, which is pretty good.
Huge.
You look at southeast Queensland, Perth, Sydney and Melbourne, that's 87% of Australia's population and job growth. And that's one of the major reasons why these markets have consistently performed quite well over the longer term. And that's, when you look at the fundamental drivers of capital growth, it's population growth, infrastructure growth, job growth. These are three really big things that are going to put pressure on a market, because, all markets are really driven by supply and demand, right? When there's more people coming into an area, there's going to be always more demand. And generally where more people are, there's going to be more job opportunities as well, because that's where the big businesses want to be, because they're going to get the largest pool of prospective employees that are going to be the best. And then the governments are obviously going to prioritize spending money on infrastructure to support that population growth as well. So that's a logical explanation to me, and I can understand that. And that's why we prioritize the metro markets over the regionals, even though there's outlier regional markets that have smash like the long-term performance of the metro markets. It's just really difficult to identify the one regional suburb out of the 12,000 that are going to end up being the winner.
You know, I love the way that you just explained that. I've actually never heard it explained that clearly. Like, I'd love to just grab that for like Instagram that little bit. That was like channeling through you. Good stuff. But it's true, man. Like, I'm too lazy, firstly, to look at 12,000 suburbs properly across 40 indicators.
And I'm too scared.
And I know, like, when I look at Australia's top 100 top suburbs in terms of performance in the last 20, 25 years, which I've done before, 95% of them are regional markets.
Yeah.
You know, like places like Byron, parts of northern New South Wales, Geelong, like Sunny Coast, Gold Coast, like some of these areas have just gone off the hook, and that's so cool. But could I have picked 100 out of 12,000, or am I better off trying to pick 3 capital cities out of 7?
Mm-hmm.
You know, and so I've just gone probability wise, like, even I'm not a gambler, but when I've been to the casino with the boys, like, I just can't stop playing roulette. 1, because it's like hell fun.
Yeah.
But 2, it's because my chances of winning are higher in that game than any other game in the casino. And so I'm like, I don't like losing money, so I want to play something that I'm still going to lose money on, but my risk is lower.
Exactly, man. Like, you've got to make it work with your risk profile.
Yeah, and so, like, you know, I love that, and I think I've discovered that in myself. And as investors, we have to figure out where we sit. Like, this concept of being a fence sitter in life and investing, to me, like, we had a Halloween party at my house recently, and I was having a chat with one of the boys, and this idea about going through life, like, I've been a massive fence sitter for so long. Like, I've never really had an opinion on most things. I'm like always open to new information and changing and growing. But like, on some things, it's good to just go, this is where I stand. It's much easier to go, I just buy houses in metro areas, not because it's my perspective.
Mm-hmm.
If history changes and shows me that, like, it's better off to do something else, I'll immediately change to that.
100%. And we have done that.
Until that point where there's not 100 years worth of data supporting a certain outcome, like, I'll do best practice. And so you mentioned the normal things that we all know. Infrastructure is the key driver of short-term gains.
Mm-hmm.
Population growth is important, but according to Jeremy Shepherd, it's not as important as population continuing to grow. So population growth isn't in itself like a crystal ball indicator of this area is going to do well, but it is an indicator that if people start rushing out of there like they do in Perth and Darwin, for example, or Canberra sometimes,
mining towns,
then it has a huge negative effect, and there's a downside risk there. We know income is absolutely tied to what people can afford to pay, but Sydney and Melbourne could almost be international cities now. So local incomes are kind of irrelevant. If, you know, there's 10 million people around the world that want to buy an asset there in the next 50 years, it'll keep things propped up.
Exactly.
But the things that people don't talk about is the entire market is the same as crypto or stocks. The exact same people buying those two markets are buying property, but because property works on a 7, 10 or 20-year cycle, people don't see the patterns as easy as they do. But the same wave of greed, then freak out, then fear, then greed, then freak out, then fear, that occur in a stock market or a crypto market happen in a property market. And so I actually think the number one driver, regardless of what anybody pretends to make up, is speculation.
Yeah, sentiment, speculation.
The number one driver is just how people feel about what's going to happen there.
Yeah, that's so true. And it's like, you look at I think it was Catherine Cashmore that did the breakdown of the Olympics around the world over the last 20 years and looked at all of these different things. It's like the Olympics actually, like, it puts a market in pressure, like they're going into a lot of debt to have the Olympics there. So, you know, whether or not it's good, but the speculation that comes around the Olympics has put positive performance in all of these markets around the world. It's just like, because there's only the athletes that are really going there, and, you know, maybe a couple of local tourists and stuff like that. But it's not like a long-term lasting impact of the market. It's just short-term speculation. It's
the infrastructure that goes in that props up the property mainly before the games.
Yeah.
You know, what I loved about that Olympic Games wrap-up was I think like the worst performance of a market was like about a 28% gain.
Yeah, like close to 30.
And some of these markets around the world have grown by over 100%
Yeah.
in the years leading up to and preceding, which is epic for Australia with an Olympic Games coming, especially at the timing because it's in the recovery phase just after the next GFC.
Yeah.
So it's like going to help Australia a little bit get back on the map and get spending in the right way. But outside of speculation, like Ray Dalio's got a few indicators that can help turn an economy around, which Australia, America and Europe have all done. And I think the next big one for like what property markets perform and why is just the ease of access to capital. Like, can people afford to buy? And is monetary policy easy to borrow? And on top of that, is the credit cheap? And it's like if you've got good sentiment, cheap credit and easy credit on top of an unprecedented infrastructure boom and savings level, like we've seen it this year. And then we're getting to a point now where like Sydney and Melbourne, I think they've already peeled off the top, and according to CoreLogic, they went over the top back in May or April.
And they need to pull the handbrake.
Handbrake's being pulled on, money's getting harder.
Sentiment gets lower, speculation stops.
Media's cycle turns from positive to negative, which is starting to happen. And then we get to a little bit of an increase in rates, which Ryan from On Property did like 30 years of analysis for me. Actually has zero effect on capital gains, but it has a short-term effect on sentiment. Short-term effect on sentiment reduces demand. Freak out, small drop.
Yeah.
Hang on.
That's a good time. That might be
a good time to buy.
Yeah. It's really interesting when you think about it, and I think maybe because in Australia, 70% of the people that own properties, it's their home. And if you look at Robert Kiyosaki's way of seeing assets and liabilities, anything that is non-income producing is a liability to him. So he looks at your own home as a liability as opposed to an asset. Now, fortunately for Australians, you might get some capital gains over that period of time when you hold the property. So it kind of does turn into a bit of an asset there. But like, because 70% of the market is driven by emotional owner occupiers, it really changes the way that things move. And you can, as an investor, use that emotion to your to your interest, right? Like and we do that with our business and with our clients and with our purchases. It's like, we'll look at areas that have got the better schools, that have got the better cafes and restaurants, that have got like cool lifestyle factors and things like that, because we know that owner occupiers are going to come in and want to pay an emotional price just to be in that suburb, just to say that they live in this suburb. And you can use that to your advantage. But that's not like a logical or analytical explanation. No. It is just emotion.
Intuition, like, hey, if I like it and I earn a good income, then maybe someone else with a good income will want to live there with their family as well.
Yeah.
Or maybe this school district makes sense, and because of that, like, we want to be around it.
And that's probably why, like, some of the top performing markets are regionals, because, like, you look at Byron Bay and it surrounds, you look at Noosa and it surrounds, you look at, South Coast, New South Wales, South Coast down like Mornington Peninsula or along the Great Ocean Road. Like, who wouldn't want to live there, right? Like, they're just so beautiful.
Absolutely, man. And I love that. Like, you just overlaid some really important things that, like, I'd miss, but it is an emotional market. And the beautiful thing about what you just said is, if 70% of Australians are non-transactional buyers over the long term, like, and 30 to 40% of those people own that asset completely debt-free, and, as a percentage of that 70%, like, a bunch of them are at like my stage of life where they've got kids and they've stopped wanting to move around all the time because it's too disruptive to the family unit. Like, that's beautiful that you can, one, use leverage with property. Yeah. And secondly, 70% of the market isn't looking at the asset the same way that you are. And we've done this, like, we've looked at what percentage of people own one property, 2, 3, 4, up to 6. And as a percentage of Australians, even though for you and I, this feels like so normal that everyone must be investing and everyone must be speculating and everyone must be learning this stuff, and why isn't everyone doing it? It's not normal. Like,
it's definitely not the norm.
Listening to this channel isn't the norm. Like, you're the outlier. Like, giving a shit about trying to improve your future, as weird as it sounds, like, isn't the norm. And I completely forget that, because everyone in my life and your lives are probably like trying to steadily improve. But like, it's a huge advantage that we have, that this information that all of you guys think is normal and us isn't normal, and these are like almost industry secrets that you can apply at the right stages of cycles to completely take advantage of them.
For sure. But like, after looking online at all of these different areas that had performed, like, there's so many Australian property markets that have performed really well. Why it really becomes difficult, like, I think one of the articles that we saw, Lakemba was one of the top performing suburbs in Sydney over the last 10 years. And it's like, growing up in Sydney, I remember the stigma that Lakemba had, and it's like, that doesn't make sense from a logical perspective that that's going to be the top performing market, but sometimes it just ends up coming through.
Hang on a sec, it doesn't make sense from an emotional perspective, but logically it started off a base where in the 10 years before it had only received 1.9% per annum, and it was sitting at a point where suburbs around it were worth 700 and it was still worth 300. And so like, logically it makes every single bit of sense that it would have done what it's done, because Jeremy Shepherd's data, it had underperformed, which means it had the potential to overperform.
And then you look at Jeremy Shepherd's data on the public housing and that not having an impact on longer term capital growth as well.
Yeah.
100%.
And this is the thing, it's like we get confused with what is logic and emotion, and as investors we want to only make sure we use logic to make our decisions, which you and I do. And it's funny, even in our language as like professional investors that do this every day, like we get tripped up on which side of the coin is which, but it's like peeling things back through podcasts like this one, like in terms of what we think can work, it's so easy. It's so simple. It's just the case of like, which fundamentals are going to become rules or principles for the way that I invest? Houses, metro markets, the better parts of the cities with the better schools, the better infrastructure, the higher income earners, the lower vacancy rates, the less supply, the more emotion in the market, which the way that we define that is the higher the percentage of owner occupiers, the more emotion. The higher the percentage of disposable household income that's not being attributed to housing, the better. Like, we can make better decisions. The place that is yet to perform in the city. Like, I was talking to a mate this morning, we went for a swim, and he's like, you know, you think Brisbane's overcooked? Like, I'm getting this question all the time. I'm like, fuck no. Like, I feel like inner city Brisbane, where suburbs have gone up by 7-8% per year for 10 years, is overcooked, if you're looking at it the way that I do. And then you've got a suburb 7Ks from that has only gone up by 1.92% per year for 10 years. I'm like, it is so undervalued. It's just had one good year in 13.
That's so true.
And people, the recency bias is like, I refunded a guy this week because he thought that Brisbane had increased in value in the suburb that he was looking at by 60K. And I was like, this suburb's grown by 60K in 13 years, bro. Like, and he thought, like, it was
perspective,
over.
Right? You just got to have the perspective.
And then he was going to like put it into the American stock market that is like all-time overvalued, but like on anybody's index by about 150% right now. It's like, and I'm just like, because I look at the stock market the same way as I do property now, because I've looked at like the 1 year, 5 year, 10 year, 25 year inception performance. I'm like, you're seeing something I'm not seeing. Am I the idiot here, or am I just looking at data differently, or am I just obsessive about I just get this concept that you've been talking about for years. There's markets within markets. Brisbane hasn't gone up by 30% this year. 5Ks in the city has. I know suburbs that we're buying in that have gone up by 6%.
Yeah, exactly.
Like, what an opportunity.
Seriously, and I think like a big part of this that we talk about as well is like understanding what it is that you want to get out of the property. You know, so having a plan, having a strategy. You know, if you're trying to short-term speculate, then this sort of stuff has a lot bigger impact on your decision. But if you're thinking about your personal situation and what you're trying to do for yourself and your family, and you can use property in a bit of a different way, and you're not trying to like be in the best suburb that's performing, you're just trying to ensure that you can achieve your goals. And it takes a lot of pressure off and allows you to do some different things as well that I do want to talk about as well, because like, whilst we understand that, you know, metro markets over the longer term have outperformed regional, and houses outperform units, all of these different things. It's like, we still like to do passion projects, like some of the stuff that you've done on the Sunshine Coast, like some of the future plans that we have. Like, I would love to, at some point in time, buy a big piece of land, like 100 plus acres within a couple of hour drive from the coast up here on the sunny coast, and maybe run some form of small business on there, like a little eco retreat or wedding or something like that. And it's like, if I'm just looking at the numbers and just trying to get the best ROI, the amount of money that I'll be putting into that deal, I could make way more money by doing something else. But what's important to me, what's important to Simon, what's in line with Simon's values and the life that he wants to be living, like you said earlier, trading that time from the kids and, choosing to be here over being with them. It's like, yes, the numbers are important and we're always wanting to get the best return on our investment. But I think like having your personal plan and your personal strategy to achieve your personal goals, like that's what's more important.
Fully, man. Like, I just love that. Like, I will agree on it's important to know what you want, but fuck, I don't agree. Like, if someone's paying me to help them buy them the best property, like, everyone should go do their personal passion projects once they're financially free. It's like,
and that's like a long-term thing. Once I am, like, I've still bought the 3 investment properties in Brisbane at the start of the cycle, right?
I'm sorry to challenge you on this podcast, man, but like,
dude, it's cool.
The concept that like it's more important to like follow your heart and your passion, but then work for an extra 30 years to do that, because not everyone's in your position where like they can earn the money that you can. They've already got a foundation of 4 incredible properties set up, all bought at the perfect time, that are going to double in value over the next 15 years, that are going to give you hundreds of K of revenue per year. So it's like we're in a stage of life now because we've bought the properties where we're paying them off, we're fixing them up, we're, whatever, selling some. And it's like, I need to remember that. Like, we normally don't talk about this stuff on the camera, but it's like, I do think it's important to recognize that like the reason I fucked up so much over the last 11 years is because I didn't have the structure. And so we go way over the top on this stuff and these podcasts about the structure, the rules, the principles, like all the stuff. And off camera and like even on most of the time, we're just laughing about it. Because I agree, like what you want to do, what I want to do is so important, and it is actually the everything. But it's like for the average investor just starting out, or for like me, if I'm like proper investment hat on, like the rules matter. But then like if I look at the last 2 projects that I've bought, which I haven't started doing what I want to do to them yet, they're on way busier roads than I'd buy for a client. Way busier. They've got, one of them's a smaller block than I'd buy for a client. One of them's an older home than I'd buy for a client. Like, I'm going to Airbnb them, which is something that we don't do as a business at all. Like, it's completely outside, and it's so much more passion orientated. It is in a market that's already gone up by 7% per year for the last 10 years, but
it's because you've got your foundations.
Fully. And it's like, when I was calling you out, I'm really looking in the mirror, like, as I speak more about this, because I'm like, it is very difficult to differentiate that logic and emotion from yourself and then just do what's logical to the market. But it's only because you've got 3 great places in Brizzy, I've got 3 great places in Brisbane as our foundation, that we're talking about playing with all this other stuff. And I think it's really important to remember that if you're just starting out, we need to follow the rules to get you in a financially free position in the shortest period of time. But then once you've got your foundation, like we used to talk about heaps, and you're gonna be fine.
Yes.
Man, like let that flavor for life come out, and that vision for yourself. And I'm sorry for the way that I interjected, but I had to talk around it.
It's so true, because we talk about this off camera all the time. Like, we got to 100% separate ourselves from like the way that we talk, because, it's nice when you've already got those foundational properties, but if you are, still searching for them, still working towards that, it is so imperative to stick to the fundamentals, to analyze the markets, to understand where you should be putting your money, to know that you can get what you want out of that investment. Like, it's so true. And there's still so much value around Australia. There's still so many great opportunities.
Perth, Adelaide, Brisbane, oh my God,
Darwin, yeah, exactly.
Sunny, like parts of the sunny coast, if you compare it to the Goldie or you compare it to Wollongong or Newcastle, like you compare it to Mornington Peninsula, is dirt cheap still.
Yeah, exactly.
I think for me where a lot of this concept came around, like really wanting to have the best approach for people. Like if I think back, it's when you and I originally looked at Ryan from On Property's article around the percentage of people that own properties.
Yeah.
And we fully recognised at that time that the average person in their lifetime would be lucky to get to 2.
Yeah.
Is when we started as a duty of care to be like much more specific and prescriptive around the rules of history.
Yeah.
And that's it. Like, and you know, many people listening to this are going to do so much more than the average. And so it's like, it's important to recognize that. But, you know, so many people listening to this as well, like will just do 1 or 2 or 3 properties in a lifetime, which is incredible and so much more than the average. But it's like, I thought at that time when I was like starting to get very prescriptive on what I wanted, that I was only going to do 3, 4 properties in my life. And I'm like, I want to hit a home run on all of them. But then I realised, like, once I'd done those properties and started to reduce some of the debt position, I'm like, I'm young, I love property, and maybe I'll start to, like, tweak the strategy in alignment with what you said. Like, the big property for you, for me, it's like I love creating affordable Airbnb stays for people that are, like, got that feeling of, like, a luxury stay, but at a price tag that mum and dad can come in for the weekend and just love it. It's an experience, and my wife loves it. So it's like, that's a tourism business that I'm in outside of property that just has property as the asset. It's like I've ripped the McDonald's model, but it's a hotel business. And it's like, that gives me so much joy doing that stuff, but it's so different than what I'd ever support a client to do. And it might not be best practice, but it feels really good. Yeah,
because when you do this for, 30 to 50 hours per week, you can kind of toy with those ideas. But if you're an electrician, or if you work in IT and that's what you spend your 30 to 50 hours per week on, like, that's realistically your cash cow, right? That's where you're going to be earning the big money from. So it's in your best interest to focus on that to earn the money. But then you always should be reinvesting that money for when the day comes that you no longer want to trade that time away. And that's where, our 2 different strategies came from, the 2 or 3 property to financial freedom strategy. It's just like, okay, well, understanding that the average Australian is only going to do this, like, how can we still try and achieve an amazing level of financial freedom if we're going to just, purchase a few properties? And like, that's sort of where, Brisbane really started to look even better, and, being able to get the combination of a decent rental yield with, some good expected long-term capital growth as well. You can start to see the forest through the trees, and you can start to see how this plan, executed correctly, is going to actually enable these people to start generating, 50, 60, up to $100,000 worth of passive income per year with an amazing portfolio, ideally owned outright. Dude, I love it. Like, if I think about this, like 5 years ago from when you started, now being business owner with a great portfolio of properties that are going to set you and Tay up for life. And now it's like thinking about new businesses, new property ventures. Like, I just watched this show where these 2 chicks flip motels, and I'm like, I want to wait for the next GFC, and then I want to go to either America and buy some cheap hotels, or I want 2020 was the year to do that, eh?
Oh, man, they were everywhere. Or up the East Coast, in the smaller markets like your Ports and Coffs, and I'm like, and you're talking about like the wedding venue or the eco retreat, and it's like, the cool thing about this, guys, is like, it's okay for the goals and the goalposts to change. Like, my actual original goal was to be worth tens of millions of dollars when I was 20, and to just fucking take on the world and work 100 hours a week and become like a global player. And then I like got a taste of working 100 hours a week, and I'm like, okay, that's not the door for me. Like, I'm not prepared to do what those ballers are prepared to do. But what I actually now know that I love is helping other people figure out the things that I missed earlier so that they don't make the mistakes I did and can get a better outcome. And it's like, your position and your vision for yourself continues to grow and change, and it's a beautiful thing to be in a position where it's like one thing stable, your properties, that will set up everything else off the back of that long term.
I absolutely love that so much, and we talk with this almost every single person on the phone. It's like, in the beginning of your journey, start with the fundamentals, identify what Australian property markets perform and why, and then get into those markets. Start with the foundations. And I use the analogy of like university or an apprenticeship. It's like when you first go to uni or when you first start an apprenticeship, you are learning the basics, the fundamentals, the foundations that have been tried, tested, and consistently worked and helped thousands and thousands and thousands, if not millions of other people get to where they are. So you start with the basics, you start with what has worked and what is going to work for you. And then over time, with compound growth, with, you know, an increase in wage or, you know, different things happening, you can then start looking at different options. But always in the beginning, you need to focus on what's been tried, tested, and consistently worked. You need to get into the best ones, and then from there you can understand that you'll be able to go further and you'll be able to take it to the next level and do those passion projects. That's so important to understand, because a lot of people are like, oh, I want to do this, that. I want to do a subdivision for my first property because I've got a friend who's just done one and they made heaps of money from it. And I'm like, I totally get that, because I'd love to make that much money from a subdivision as well. But you know, maybe we should start building a little bit of experience first. Maybe we should start building a decent portfolio first. And then off that, we'll be able to leverage into, you know, different opportunities.
What I think about when I hear that, because I've heard that like 1,000 times as well in the last 6 years, is like, what I'm hearing is like, now that I know what I'm hearing, because in the past I thought it was like, I want to do a subdivision. It's like, cool, we don't help people do subdivisions, mainly because they're too risky and they haven't been, I don't think they've been viable unless you're a professional for like 5 years in Australia.
I've heard more losses than gains.
Yeah, I heard another one yesterday, just 9-lot subdivision, lost 600k in South Brisbane in the last 2 years. You know, it's kind of like, the one thing that keeps coming back to my mind is like, when I hear the subdivision thing, is I want to make easy money and I want choices. And it's like, it's not that they even want to make easy money, it's just that they're looking, and I was looking for a way out of where I was at, which was no future that looked really bright and no choices in the short term that were in alignment with the values and person that I am. And so now that I hear those things, I'm like, cool, I completely get it. And there's so many great companies out there that can, you know, help you speculate if that's what you want to do. But it's like, if you like simplicity, a really good foundation of 2-3 properties that over the long term are going to make you wealthy and also financially free. And it's going to be a bit painful to get there with savings and equity and doing the grind until they're set up. And then after they've set up, it's not over. You've, you know, got to have a plan for paying them off over time. But it's like, if you can go through that pain, and it's kind of like the Bruce Lee thing. Like, I think about him all the time, and he's like, I don't fear the man that's got 10, you know, done 100 punches in 10 different ways. He's like, I fear the man that's done one punch 10,000 times.
Yeah. And
it's like, there is something so important at the start of your journey. If you're not already financially free, you're at the start, in my mind.
Yep.
And I'm not financially free, I'm at the start. Like, I'm still learning every
working.
single day.
Yeah.
Still working at it, still saving.
I know I'll hopefully get financially free sooner, but I don't want to ever stop learning. Yeah, always be learning.
At the end of all of your adventures, you realise you're back at the start and you're seeing it all for the first time again. Yeah. And it's like, I love that quote. And it's like, we're not trees, we can move. And just because you've got a fixed idea at the moment about how it should be or where you should be, it's like, okay, use that as motivation to get from A to B. And then when you get to B, recognise that it's cool to change, and like, it's cool to have banter about it, and it's cool 100%. For people to challenge you, and it's like, that's necessary. The way that things improve. It's like, we're just in this business and with our clients, constantly learning, constantly being challenged. Like, my clients are teaching me shit every single day. Simon is like, at least 3 times in the last year and a half, he's been like, don't buy that. And I'm like,
I want to.
Okay, like, I get it, because I'm not saying what you're saying. And it's like, you need that. And I think that's one of the major things that we support our clients with.
Yeah.
It's not just we buy a great property, we help educate them on the market, and we introduce them to a world-class team. It's like we see your blind spots because this is your first call, but this is our 10,000th call.
Exactly.
And this is the 800th property we've bought, and this is the 10,000th call with an agent in the last 2 years, and this is the 100th property we've looked at this week from a very particular lens. And it's like, if you want foundation, like, I don't think anybody does it as specifically as we do, because I don't think anybody's as obsessed about this shit as I am, or you are, or Crystal is, or Hayden is in the entire industry.
We just give a fuck. Like, we care, like, number one for other people, because it's a lot of money, and like, we would love to see a world where more people are financially free. Like, it just doesn't happen in the current way that people live, and it would be so nice to see more people financially free, more people living in alignment with their values, more people helping others. Like, seems like a great world. But on top of that, like, we're invested in all of the areas that we're telling people to invest in. Like,
I'm all in.
I literally am. I'm all in in all these areas. And it's like, you know, we're going to go that extra mile. We're going to do that extra research. You know, how many nights have you stayed up till 2 a.m. because you found yourself down the rabbit hole trying to identify what the next best move is for yourself and our clients? Like, it's just like, we're so obsessed with this stuff because we give a fuck, and we just want the best outcome for ourselves and our clients, and we want to see more people financially free. Like, that's where we're coming from. It's not trying to make 50 or 100 grand in 1 year from one deal. It's like, how can I replace income long term so that I've got more time to spend with my family, with my friends, with the people that we love, and more time doing the things that are going to have a bigger impact on the world.
Man, you couldn't say it better. Like, I talked to a friend of mine and a previous client, Tim, yesterday, Arvo, and he's just such a pleasure to speak to. One, because he's got 5 kids and he's like under 40. 2, because he's been running like a really good, hard business in the marketing space with like 20 employees for like almost 20 years now. But 3, like, this guy bought his first property with his mum in 2001 in Brisbane, and he bought another one in 2003.
Great timing for the Brisbane cycle, by the way, 2001.
2001 was a good time. Then 2003 was not so good, 2005. And it's like, and then he's one of those guys that's legitimately gone through 13 years of nothingness in Brisbane, still believed in it, and bought properties recently. And now he's at a point where, like, this year he's seen ridiculous growth because it's been its first good year in a long time. And he's got to a point where he's just been the go to work hard, chip away at the properties and not sell anything over 20 years. And he reckons by the end of next year, he'll be at 300 grand a year passive.
I love that.
Like, he came to us after he'd already been investing for 15 years because he wanted to, like, pick some stuff up. And we just became great friends. Like, we went to a seminar for like 15 days together, like 5 or 6 years ago. Like, a beautiful person. I'm like, and it's inspiring. I'm like, if this guy can do it and still have a great family life and train and work in an incredibly stressful business, like, you couldn't have had a more stressful 2 years than in advertising, because no one's spending above the line money.
No.
And he's still, like, seeing it through and doing it and chipping away and just paying principal and interest on a property for 20 years. He's like, I've done it, Ben. And what I love most about this story isn't any of that. He said, I'm 40, Ben. I've got everything I need to completely change the world and help people for the better. And he's like, I'm spending all of my Christmas break from now till then thinking about how I want to impact the world the best. And not only that, thinking about, now that I'm financially free, how I want to spend my time, because I've been giving it away to everyone else for so long without people recognizing it. Like, in the last year, he's had clients that he would have charged 100K and he's been giving them that product for 10K just to keep the doors open. Like, he's like, I'm sick of it. And he's like, I'm now financially free and I'm going to choose what's best for me, my family and the world, and how I want to serve with all of these incredible skills. And I'm like, man, please come and work at Pumps. Like,
yeah, what an
please come and share your
guy.
story and strategy with people so that they can do it and I can do it.
Yeah, it's so nice to just see somebody that, like, set an intention, created a plan, and just chipped away at it. And like, that's the reality, 20-year journey is how long it's going to take most people. But if you consistently chip away at it and keep doing the reps, you'll get there.
What could be harder than doing it while having 5 kids and trying to run your own thing and a global financial crisis and
an underperforming market for an extended period of time?
Like, and he has lost money as well, like a bunch of times, and gone through subdivisions and bought regional stuff and speculated on this and that. And it's like, and he still ended up getting there from just growing, and he's been a beautiful person on the way through. And I want people to get that. Like, you do not have to change the core of who you were born to be on the journey. I lost myself on a big part of my journey for a while because I just went, we're not supposed to be all in on one thing, I now realise, but like, it can help speed shit up, but it can also like cost you a bit. So it's like, just enjoy this and enjoy the person that you are, and know that it'll change, and know that you're going to be challenged on the way, and it's going to be scary, but there are rules, and what's going to perform next best, who fucking knows. But I do like Brisbane, I do like Adelaide, I do like Perth, I do like Darwin between now and about 2025. And what happens after that is like, who knows?
Yeah.
And we'll just roll with the punches as those things come up. And then if we're not selling during a period of time where markets might go down for a while, we come out the other side and we get excited about what we picked up on the way through.
There's always going to be a new opportunity. There's always going to be a next best area, right? Like, there's always going to be a new crypto or like a new whatever it's going to be. So yeah, just keep learning and keep talking to different people and keep doing the reps, putting the money away, reinvesting that money. And yeah, I'd love to see more stories like Tim come through, and I'm sure we will over the next 10 years, because now that we've been doing this for a long time, you for over a decade, the company for over 6 years now, it's like that a lot of these stories are going to be coming through, and I can't wait to get people like Tim and others on the podcast as well to share those stories, because we're all just fumbling through this journey of life, and who knows what's going to happen next. But I feel as though if you've got that value of just continuous improvement, learning a little bit more and implementing those new things that you learn on that journey, and not being like that arrogant person that just gets stuck in the mud, just being fluid and being able to change with the times, like, it's always going to be a brighter future.
Without a doubt, man. I really enjoyed this one. I'm so grateful, guys. If you're still listening, please give us a 5-star review. And we just truly wish you all the best, no matter what time of the market cycle it is, good, bad, indifferent. Please, try and apply some of these fundamentals and just enjoy the experience and become the best version of yourself along the ride as well. Like, Jim Rohn says it better than anyone, and it's like, don't become a millionaire to become a millionaire, but become a millionaire for the person you have to become on the journey, because not everyone can do it. It's tough. It's like tricky, and it's grueling, but it's like, if you can just dig in there and enjoy the journey and hold on, and as you said, know that it takes 15, 20 years, not 5. My God, the other side of what's awaiting, I'm hoping, and they tell me, is positive.
Fingers crossed, man. Let's just keep doing it, right? Oh, sweaty. So sweaty.